gotten itself into this neutral spot, almost back to the highs, no longer overbought or oversold, right into this big data week. Macro's going to pick up next week.
All right, you have a great weekend.
You as well.
That's Mike Santoli. Thank you. Everybody at home, please do the same, but not until overtime plays out. We go there now with Morgan Brennan.
The Dow closing higher for the 8th straight session. The Nasdaq and S&P 500 finishing out their 3rd straight weeks of gains. This is the 4th straight week of gains for the Dow. That is the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. Well, coming up this hour, Evercore ISI Vice Chairman Krishna Guha joins us with his predictions on inflation and the Fed ahead of a big week of potentially market-moving data. And an analyst who calls himself, quote, probably the street's biggest Novavax bull, joins us to talk about the news that sent that stock rocketing higher today, basically doubling. Let's get to today's market action, though, with our panel. Joining me now is Scott Wren of Wells Fargo Investment Institute and Dana Dioria of Investnet. It's great to have you both here. Dana, I'm going to start with you because it's been a week in which stocks have traded in a, I'd say, relatively tight range. Nonetheless, we're seeing gains. The S&P 500 is something like 1% from its record closing high not that long ago. The fact that we've seen this reigniting of equities, what is propelling it, even as we have seen the economic data start to slow down and show some signs of stress?
Yeah, it is an interesting mixed picture here, right? And of course, coming off a day where we saw consumer sentiment is starting to flag, concerns about inflation probably having a lot to do with that. In fact, we know that pandemic savings have really dissipated at this point. So, what is holding up that consumer is, of course, the employment picture. But, the employment picture is still very strong by any measure. But, we did see unemployment tick up a bit. So some interesting mixed news. And yet, you're right, the market remains very resilient. So I think the answer is earnings season had quite a lot to do with it. Earnings season came in largely, pretty robust. And yes, you are seeing some where if they're not hitting the mark, they're kind of immediately punished by the market. But for the most part, earnings have been coming in robust, and we're looking ahead to, yearly estimates that are still pretty strong. So I think that's holding us up right now with the market.
Okay. Scott, how do you see this market, especially given the fact that we did get that University of Michigan consumer sentiment report this morning? It showed a sharp deterioration in confidence, but it also showed an upward shift in inflation. What matters more here?
Well, I think in the end, Morgan, it is going to be, inflation. Is it going to come off? And I think that, as we move to the end of the summer and into the fall and probably into 2025, we're going to see some sub 3% readings on CPI, and that's going to be a good thing. And that's probably going to allow the Fed to cut a couple of times this year. And I think the market's pretty confident that inflation, and it might take, it's taken longer than what a lot of people thought, but it is going to trend lower. And I think as far as the sentiment numbers this morning, and I don't think it's a big surprise that, you see gasoline prices high, you see grocery prices high, sentiment oftentimes is pretty tied to gasoline prices. It's certainly been tied to inflation in this cycle. And we all know that consumers, what they say, U.S. consumers, what they say and what they do are two different things. And I think you can make the argument that if consumers are employed, they have money in their pocket, they're Americans, they're going to go out and spend money. So, I mean, we think the unemployment rate's going to probably crawl a little bit over 4% by the end of the year, which is, not anything disastrous or anything like that. But I think that just the thought of earnings hanging in here, the economy being better than a lot of people expected, and inflation, tracking lower, even with, a few things that have happened lately data-wise, that's what's really keeping this market buoyant.
It sounds like we're realizing the soft landing scenario based on what you're saying, if I can pull out that implication, Scott. Dana, the fact that we're seeing utilities, financials, materials, you even saw staples catch a bid this week. These were the best performing sectors on the week. And actually, tech was one of the worst performing sectors. What does that tell us about the recent rebound we've seen in this market?
It could be a few things. I mean, there's sort of some longer term impacts here. There's obviously the narrative now, higher for longer. You certainly have the Fed out there trying to, instill the message that they aren't going to move that fast to cut rates, whether that transpires or not. We've got a long way to go, right? First rate cut now expected in November. So a lot of data that needs to come in between now and then to see where that actually goes. But, when you look at something like tech, where it's longer dated, a lot of the tech story, not entirely, of course, there's a mosaic here, but AI, of course, is a big impact on the tech story. Not a lot of data that people can actually put into models at this point around how quickly AI is really going to bounce. So, movements and things like, higher for longer, and these could be longer dated cash flows. I think you have kind of secular impacts like that. And then you have short term where, the market has broadened out. There's an argument to be made for just there is resiliency in the economy. And so you should expect a broadening out in what participates.
Okay. Dana and Scott, thanks for kicking off the hour with me. Happy weekend to you both.
Thanks, Morgan.
With the NASDAQ finishing just below the flat line, everything else, and the Russell 2000 lower as well. Everything else, though, in the green this Friday afternoon. Let's turn now to the IPO news of the day. Chinese EV maker Zeekr making a strong public debut at the New York Stock Exchange. This is the first major listing by a Chinese company in the U.S. in years. The company's CFO was on Squawk on the Street earlier, talking about Zeekr's positioning in the crowded Chinese market.
If you look at the big picture, the market over there is very, very crowded. But if you zoom in a little bit and you look at each of market brackets, price brackets, there's definitely an opening in the premium market segment. Say, for example, Zeekr, we've been selling, cars mostly priced between RMB 300K to 500K. So we've been competing with the likes of Mercedes, Audi.
Well, let's bring in Bob Pisani for more on today's debut. Bob.
Hello, Morgan. Zeekr had a great day. They priced at $21. They opened at $26. They closed at $28.26. This deal was very significantly upsized. So the original price talk was 17.5 million American Depositary Shares, ADSs, at 18 to 21. But they sold 21 million ADSs, so there was more shares sold, and they sold it at $21. That's the top end of that range of 18 to $21. So put it all together, they raised $441 million. The fully diluted valuation right now is over $6 billion for the company. Now, that's a lot. As Morgan said, it's the largest Chinese listing since 2021, but this is well below the slightly more than $12 billion valuation that the company had at the last round of private funding in 2023. So there definitely is a valuation haircut here. Zeekr, by the way, is the premium brand of the Chinese automaker Geely, which also owns Sweden's Volvo cars, and it also owns the UK's Lotus sports cars. Despite the very small float, this is a good sign considering Chinese IPOs have been few and far between in recent years. And also, remember, EV makers like Tesla have seen their shares slide. So this is a nice little pop despite the small float. The company is among a very large crowd of China EV producers that's trying to stand out among a string of China competitors, particularly in Europe, including, of course, BYD. As for where we are in the IPO market right now, Morgan, it's been a decent year. We've raised almost $20 billion in total. That is a lot better than the disastrous years of 2022 and 2023, but we still need more companies to go public before we hit a normal year. And if you're wondering what's a normal year, we would typically raise, prior to 2020, about $50 billion a year. That was the average raised each year in the 2010s. By the way, Morgan, one very unusual aspect of this deal is that the parent company, Geely, said they'd buy up to 90% of the shares in the IPO. Now, we don't know what actually happened here, but we did have a Reuters report that they bought up to 60% of the deal, and that some minority investors, including Mobileye, also brought another 10%. If that is accurate, as Reuters was reporting, that means that insiders essentially still own about 70% of the company. So it's a very, very small float that's out there right now. One reason I think perhaps you had such a big pop today. Morgan?
Exactly. And of course, that context is key when you do have a pop like you had today. I am curious, though, because and the company ended the day. It's such a small cap now. But Sam Altman's nuclear energy company, Oklo, also going public after merging with a SPAC. We haven't talked about SPACs in a while today. How how does that speak to, again, this deal environment? What's working?